key question here is, has the market already priced in all of the positivity we could possibly get from this Trump-Xi meeting on Thursday?
I mean, I don't think we're quite there yet, and I think we're going to have a lot of ups and downs before we get there. Now, China and the U.S. are the global growth engine. So when we were talking about 100% tariff rates, that was very scary because it was very negative for U.S. growth. It was very negative for China growth, but it was very negative for global growth. And that's really the concern here. And for risk assets, that's why you see a sell-off when you get escalation and you see a rally when you get de-escalation. Now, I don't think we've quite priced in a full kind of resolution of this trade, but I think we're certainly headed in the right direction. And the reason for that is that there's a reason they de-escalated back in the spring, right? It's the U.S.-China trading relationship is more equal than any other relationship the U.S. has. The U.S. is reliant on China for rare earths, whereas China is reliant on the U.S. for tech. And so there's a reason that they want to make a deal more so here than elsewhere. And I think for equities in particular, unless you get something growth negative out of these talks, then you can have that momentum trend upwards.
So we're not worried about inflation anymore. We're not worried about how everything's going to get super expensive, we get tariff pass-through going to go to consumers. What happened to that narrative?
I mean, I'm still very worried about it, but I think more for the U.S. than elsewhere. So in the U.S., I think it's just delayed rather than removed entirely, and it's because we had that massive front loading. You also have different inventory cycles for different products, and you don't know what products really were front loaded and which weren't, or what kind of points you need to be importing different things. And so I think while it's less likely we get a very high peak, it means we stay above the Fed's target for longer. For these other countries, though, it's more disinflationary. So Europe, for example, that's where I'm thinking mostly, because you have a demand shock, but you also haven't imposed retaliatory tariffs. So you don't have that price level adjustment. Your weak demand means that there's certainly nothing feeding through the economy in a more menacing way. And for me, that means that you're likely to see a more dovish ECB into 2026, although it's highly unlikely we're going to get that shift at this week's meeting.
Well, we also have the Fed meeting this week, the Bank of Japan, also the Bank of Canada. Where do you think those surprises can come from?
Yeah, I mean, on the surprise list, ECB is the lowest. I think it'll be a relatively boring meeting. They've said for a while that 2% is where they kind of want to stay, and so you need something downside surprise-wise on inflation to change that. For the Fed, though, I think that's potentially more interesting, although last week's softer inflation print means that we're pretty sure we'll get a cut at this meeting. We haven't had a lot of data in the in-between.
Balance sheet runoff, do you think that could be a surprise?
I don't think it'll be the market doesn't really care that much because it's something that's been well telegraphed ahead of time. The Bank of Japan definitely falls up there more so in terms of being interesting because they could signal that they're hiking in December. Although, again, you're 2 months away from that. You know, there's not a need to signal that right now, and there's nothing priced for this meeting. So that leaves the Bank of Canada, which usually isn't top of the list, as potentially the most interesting. There's around 22 basis points priced right now. I think they likely will cut, despite the fact that they've got very sticky inflation, because they're still dealing with those tariff issues, and that's really putting downside on their growth prospects. If they do cut at this meeting, that brings them to the bottom of their neutral range. And I think the question from here was, if trade negotiations are going so poorly between the U.S. and Canada, you can't close the door on more cuts. And so that could weigh on CAD.